Well, what worked in the first half of the year doesn't seem to be working now. We've got markets breaking down, the Dow's negative for the year, and we're seeing interest rates at levels we haven't seen in decades. What does all this mean for you, the investor? Joining us from Market Gauge is Mish. Mish, I want to go to something you just put out, and you said you're waiting for three things before committing to a particular bias on investing. One, how do junk bonds do and perform against, let's say, TLT, which is treasuries? How is retail and transportation doing, as that's sort of an inside look at the economy? And number three, how does DBA, which is ags and commodities, do relatively to a strong dollar and higher yields? Let's begin with that. Why these things are the focus of your attention?
Because in our risk gauges that we have, we don't just look at the pure price performance of these individual instruments. We look at how the performance is relative to the performance of something else, the ratios, if you will. And so if we start with the junk bonds that you mentioned, the junk bonds have come off. They actually took out the 2023 lows this week, and they're popping back a little bit today. But we measure them against the long bonds or the TLTs. And so since they both have come down a lot as yields have risen, the junk bonds continue to outperform the TLTs. And we consider that a risk on. Not necessarily as great as if everything was going up, but still risk on. So that's a positive. Then we also like to look at the relationships, as you mentioned, the inside sectors of the market, particularly retail and transportation, but we want to throw small caps in there too. Why? Because this is, and Stanley Druckenmiller coined this phrase years ago, the inside sectors of the U.S. economy. So you really want to see what is the reaction of these much higher yields and the stronger dollar. That's where you're going to look. So what do we see right now? If you take a look at retail through the ETF XRT, it never, first of all, really participated in the rally that we saw in the first 6 months of the year. Sure, it went up, but it never took out anything close to a 2-year business cycle high. It got right up to the top of it and failed, while SPYs and even IWM, small caps for a month, but certainly and growth stocks did. So that's telling you right now that retail's never really been all that excited about the idea of a great economic growth situation or a soft landing. However, transportation has outperformed, which is interesting. So goods are still moving, and that's obviously a positive. We want to see that demand side still strong. But now it has to prove itself here. So that's why we're really focused. It's outperforming the retail. It's outperforming the small caps. It's definitely not outperforming growth. But if that starts to really waver from here, I think that along with retail, we start to think more recessionary. And then I really have to talk about small caps in that scenario too, Jim, because they tested this week for the first time since COVID, when it broke for 2 months, the 6 to 7 year business cycle that we measure through an 80-month moving average. And so, but 13 years, if you discount March and April of 2020, they have held in an uptrend, not as strong again as anything we've seen with growth, but certainly not signaling any major recession. And it tested it, currently holding right here. But if we start to see any failure there, along with what we just mentioned in retail, even with a risk on and junk bonds still falling, that's when things get dicey, which is why people say, oh, we want to see yields much softer. But I also say be careful what you wish for, because if they get much softer from here, the interpretation could be the Fed is worried as opposed to the Fed is confident. But then you mentioned DBA. To agriculturals, which we've been very, very interested in for quite some time. If you look at it in terms of its performance to the SPY, to the S&P 500, it's still outperforming even with this correction. Before we started, we talked about the 70s, and we'll get back to it. But to see this type of correction in the agricultural commodities is not unusual because it's the nature of commodities. They're very volatile. But what we really have to ask is if it continues to outperform and we see any kind of reduction or pause or change of monetary policy in rates, and we see the dollar, which looks like it may have topped a little bit here, also fall, it makes you wonder what has really changed in the environment. People were anticipating demand destruction, but yet we still have low supply. And we still have China, which is kind of on vacation right now, which has already proven that it has a tremendous amount of demand with low supply in many of the raw materials. So we're watching that area very carefully too, to see if we don't bypass recession or economic growth and skip right into stagflation as we enter 2024.
You bring up some interesting points about the economy. One thing that really strikes me is the job numbers they report each month, and they celebrate, look how great we're doing. And then if you look in the following months, they revise them much, much lower. Nobody talks about it. The other thing that struck me, if the economy is doing this great, why are government tax revenues down by $350 billion? We're down to $4.3 trillion now. If the economy was doing great, you would expect to see higher tax revenues for the government. That's not the case. They're falling.
I mean, and that's the thing for this whole period of time since COVID is all these historical relationships that economists sink their teeth into to give them a definition of what should be happening have changed. And just looking at the government, again, before we started actually recording, we were talking about the debt. So look at that. You had mentioned that it went from 33 trillion up to 33.5 trillion within 10 days. And so the government, people could say broke. I don't want to really kind of scare people by saying that, but it certainly doesn't look like there's any kind of consensus in terms of what we should be doing right here and right now as far as spending. I can't remember dismissing a Speaker of the House, a Republican Speaker of the House being dismissed by Republicans. I mean, it's really interesting right now. So the tax revenue is saying that kind of like, I think it's really supporting one of the reasons why the market's still up is that people still are holding on to cash, that they started getting the stimulus money. Then they didn't have to pay student loans. And I know Biden forgave some more loans today, but not nearly as much as considering it became unconstitutional. And now, with people have money in their pockets from government not collecting taxes, this is not a sustainable or good situation.
You and I were talking before we went on the air. We were talking about the 1970s. And I think of, government spending, deficits, strikes. I mean, they settled the writers' strike. And what do we have now? Healthcare workers going on strike. We still have the UAW on strike. And so you see a lot of these things in the pipeline, in my opinion, Mish, are inflationary. I mean, government spending, people striking for higher wages. I think the auto workers wanted to start out at 40%. I think they're trying to negotiate 20%. I mean, that has got to be in the pipeline down the road for more inflation.
Yes, absolutely. I couldn't agree with you more. And also look at the implication because unions, I don't remember hearing anything about unions since the 70s. And you mentioned the 70s. There was a movie that Spike Lee did about the 70s called The Summer of 77. And I feel like we're in some ways repeating that because there were massive strikes. There was a tremendous amount of violence. Theft is out of control. Even locally, I heard that the Kohl's, for example, had to close in Albuquerque, New Mexico because of theft. CVS is talking about closing stores because of CVS. You have to wonder when people start stealing shampoo. What does this say? So if you think about what the strikes really mean and the theft really means, and the fact that, like I said, the consensus on feeling good and soft and fuzzy about the government is really low. And we still have geopolitical problems. We still have issues with China. We still have issues with Russia. We still have BRICS floating out there somewhere. We have a lot of dissension around the world against the West. You have to say, what breaks? What breaks? And so we just bring it back home, back to the 70s here, the nature and volatility of commodities. From 74, the CPI went to about 14%. In 76, it went down to 2%, and this was after oil dropped. And we're seeing oil drop right now, which, of course, then in 76, as we were looking at recession, gave the Fed reasons to become more quantitative. And so once they started easing up on the interest rates and the dollar started falling, then you know what happened. All of a sudden, in 76, things started to reverse. And by 1980, that CPI number was now at 19%. And it almost seems like we could be making those same kind of mistakes again, because what didn't change during that time was there was still a real supply issue going on with raw materials. just like we're seeing now. So yeah, oil's selling off as we're speaking because people think, recession, demand destruction. But we also know that we're at historical lows in terms of our own reserves, and OPEC Plus and Russia are still continuing their cuts. So there is a situation with oil supply, and that will stem through other raw materials too. And particularly if we start thinking about China, which everybody likes to think is doing horribly. But the truth of the matter is they have a much longer term view, and they could start to stockpile some of these commodities at cheaper levels in a short supply. So yeah, that's a very long answer, but that's kind of all the stuff that I think about.
Well, we've got government spending just like we did in the 70s. We've got the Fed. I mean, people forget how much the Fed expanded its balance sheet over the last couple of years. We've got that. We've got strikes going on. We got rising oil prices. We have shortages of key commodities. I'm just thinking of this green transition. I'm writing a story now, and I was looking at how much raw materials go into a Tesla, a windmill, and a solar panel. Where in the heck are we going to get these materials? Copper. I was really blown away when I found out how much aluminum goes into all these devices. Where's this material going to come from if we're not doing mining here? Are we going to have to go to China for all this stuff?
Well, right. And look what's going on with China. We're not exactly doing well when it comes to having trade relations with them. Yeah, I mean, and then mention lithium and uranium and silver, which is so cheap right now. Yeah, all of this is definitely a concern. And by the way, natural gas, I read today, we're starting to export a lot of natural gas. And you know, when we export, like we did with oil, to European nations, we charge higher prices on top of a higher dollar. So yeah, all of this sounds like kind of exactly like the 70s, is that everybody got really complacent, that all of this was over. The war in terms of the embargoes with oil in the 70s was over. Everything was fine. And then boom, things weren't so fine. So yeah, I think you have to keep an eye on it. Is that the investment strategy? Would you buy falling knives in some of these commodities right now? No, but if I saw any kind of support levels, you know, if we just look at gold, let's say, if it really holds up here around $1,830 an ounce and gets back through, let's say, 1865 an ounce, I think that's kind of telling. You know, I like to look at sugar as my barometer. If it really holds here above 25 cents a pound, does that mean that that's going to go up? Olive oil, there is no olive oil, and those prices have skyrocketed. There's a lot of distortion, and yet this market just tends to ignore all of it and looks at the growth stocks and say, well, just pile into growth and you'll be fine.
Yeah, the Magnificent Seven. You know, the thing that this is anecdotal, but it really struck me. Costco selling 1 ounce bars of gold. They can't even keep them in stock. So what does it tell you when your Costco shopper is buying gold? That sort of reflects all of the things that we're talking about. The riots, the civil unrest, and all this social things that we're seeing right now. And people are buying gold at Costco.
Yeah, it's crazy. And then the other thing you're going to hear a lot of analysts say is seasonally, pre-election year, markets scream higher. So get ready. This market's going to new highs. And listen, I'm a trader. I'm an opportunist, right? I love to have these conversations and look at these and think about the possibilities and then trade upon the possibilities. But I also have to consider maybe we are still in this la-la land through the Magnificent Seven, and that will spill over into confidence in everything else. And people will say, well, if inflation doesn't go up much higher, where Fed funds rates are right now, we've reached some kind of a normalization, the economy is strong, soft landing, jump back in the pool. It's all possible right now. What's so interesting to me, though, is where we are in the charts, again, going back to that 80-month 6 to 7 year business cycle. We sat on it. That's a place to bounce from or a place to fail from. And I know that doesn't sound very committed, but I think you'll know the answer to that very soon.
Yeah, I just don't see how things can go in this manner. And I think we were so used to the way things worked in the business cycle in the market for 40 years. We had lower interest rates for 40 years, despite the crisis, the Fed printing of money. But I think one of the big differences now is fiscal dominance that we're seeing with government spending. I've never seen this kind of spending. What you would expect to see if we were in a major recession, like the financial crisis of 2007 and 2008, or maybe the war, World War II. I mean, you look at these numbers and they're just astronomical. And I think we're in a whole new paradigm, probably closer to what we saw you and I talking about in the 1970s. I don't know if people are prepared for that yet.
Well, you almost answered your own question because of the government spending, it's one of the reasons why we aren't necessarily in a recession just yet. The government spends money to keep us out of a recession. Now, a lot of that money, of course, has been sent to Ukraine. And from what I understand, we're continuing that commitment to send money to Ukraine. But it's also right. It's everywhere. The whole Inflation Reduction Act and the infrastructure program and all of that, whether you think it's good or not, right, it's in the face of a lot of government spending when you mentioned tax revenues are not matching. And at the same time, where printing money would be going on because secretly we know that the Fed has been increasing their balance sheet, not necessarily reducing it. And something that could escalate as well, as we mentioned earlier, if foreign governments like China aren't really, they're selling our debt, not necessarily buying. So for people like you and me who love to look at all this stuff, there's nothing more fascinating. But for people who are really looking at their 401s and haven't necessarily taken a chunk into fixed income, or the younger people who really want to figure out what to do, it's hard. I'm hearing people come on just to keep buying NVIDIA, keep buying Tesla, keep buying Microsoft, keep buying Google. AI is the future. You can't go wrong. Corrections, just dollar down average. And I hear all of that, and that's not necessarily my way of investing because we're very risk averse. But at the same time, it's about the only thing people can say right now. So even that in and of itself is frightening to me.
Yeah, the fact that they're looking at this and they're not seeing some of the downside risks that you and I are talking about, because I think they've been so programmed for so long. This is the way things worked. Well, eventually the Fed's going to bail us out because they've always done that in the past. But I don't think they're listening to what Powell said is we're operating under cloudy skies. To me, that struck me as we don't know what the hell we're doing here.
Well, I also saw another interesting comparison to 2018. Now, in 2018, we had that taper tantrum, which didn't last very long, right? Buckled. And then, of course, they reversed policy and everything rallied up. And that was part of what created the major shortages in a lot of the commodities once we got into the COVID situation. But gold was so oversold at that point. And so I also think we can look at, right, the Fed didn't know what they were doing then. They didn't know what they were doing when COVID hit. And now that they have done such an incredible, spectacular rate of change so fast in the interest rates, do they really know what they're doing going forward? And based on logic and past performance, I'm with you. We'd have to put a big question mark on that.
So in summing up, you've got three things that you're watching to kind of tell you when you might have to pivot or, maybe just sit back and stay cautionary. Do you see this unfolding by year end? In other words, how long can this continue in this pattern we're in now where it's not quite sure where it's going to break yet?
In this day and age where things move so quickly, I think it will resolve pretty soon. I mean, here we are in October, right? So October can be the lows and the great of a start rally. October could be 1987 where we see a 20% decline. So I would think that here we are, very beginning of October, testing these critical levels. If we don't see a rally starting soon and we start to see more of the relationships, let's say bonds are starting to go up because yields are falling, but junk bonds don't necessarily participate. That ratio flips where bonds start outperforming junk bonds or bonds start outperforming SPY, I think lower. But if we can muddle through that, if we can, we'll know that soon enough because we'll start to see retail and the small caps and the transportation hold these critical lows and move up a little bit. How far, we don't know yet, in which case the risk gauges will stay sort of on 3 out of 5. And then, money will pile back in. And of course, then I think we'll have to revisit this whole inflation discussion again because the more money that's floating around, the more inflationary that's going to be.
All right. Well, listen, Mish, as we close, I love the work that you do. If our listeners would like to find out more about things you do, tell them how they can easily do so.
Well, we have a website, marketgauge.com. So if you're interested in seeing, I'm interviewed a lot on media. And so we have a media tab that updates all of the media hits. So you can listen to me. That's one way. If you want to talk to me directly, I am very active on X. At Market Minute is my handle. I love to answer questions. I don't care what those questions are. To me, if you're asking me, that means you're looking for an answer and I will provide it. So those are the two probably best ways. And then I have a daily that goes out every day that I post on X, is also on the website. And that gives you my daily thoughts about things like Exactly what we talked about today, these risk ratios, the relationships, the monthly charts, etc.
Any news or any forecast on Kelsey and Taylor Swift?
I first heard about that. I was so excited because I thought the two of them are perfect for each other. They both have explosive careers in completely different areas, so they don't have to compete. I like that. She needs a bodyguard. I mean, who's better than Kelsey, right? He's a big boy. I also think, though, it's possible that it's not necessarily a love connection and more of a publicity thing. That remains to be seen. That's the skeptical side of me. But yeah, I've certainly been making football watching more fun, and I love the Kansas City Chiefs anyway, so it's just added to the entertainment of it all.
Yeah, one of my favorite teams, and I think the game last Sunday, 28 million viewers, almost as much as Super Bowl. So great for marketing. We'll end on that note. Always great speaking with you. Take care.
Thank you so much, Jim. I really appreciate you having me on.